And Brian, do you, if I give my update here, do you need me to stay on, or do you guys have other business? How do you?
If you have the time to stay on, I think it would be good if you can, because later in the agenda, toward the end of the agenda, is discussion of the implementation plan for the investment policy.
Okay, sure.
And I mean, we've talked quite a bit about it, obviously, but hopefully we can finalize it.
Yeah, great.
Looks like we've now got everybody.
Don't crash.
You think I'll be able to read the notes?
So I think Michael has volunteered to be the recording secretary.
Thank you. Sorry about that. I had a work emergency I had to take care of here, but I did review things beforehand, but don't think I can record.
Great. You guys are currently live. You're good to go.
So this is Bill Stevens. I am the new commissioner liaison, and Brian, I was wondering if we just spend 2 minutes doing an introduction around, since some of you guys I've met, some guys I haven't, and just a real quick review of the investment committee.
Sure, we'll use this as our roll call, which is the first item on the agenda.
Wonderful.
As well. I'll kick it off. I'm Brian Prevor. I'm the new chair to the committee. I've been on the committee now for about a year, maybe a year and a half. I am a property owner in Dewey at the corner of Houston and Baird. Been there since 2014, but have been coming to Dewey for probably 20 or 30 years now. My personal experience, my professional experience is I'm a lawyer by trade, and I work in the compliance field in investment management, investment services. So I will turn it over. Whoever wants to go next. Jimmy, you want to go next?
Sure. I'm Jimmy Lee. I've been on the committee for about 4 to 5 years. We split our time between Wilmington and Dewey Beach. In the summer, we're down on the Van Dyke Street, and in the wintertime, we're down here in Naples, Florida. I worked for the DuPont company for 38 years, mostly in business and sales roles, and I'm glad to see some new faces on this committee.
Great. Dennis, you want to go next?
Yes, I'm Dennis Trencher. I live on Chesapeake Street, full-time. It's a condo. I've been on the committee for approximately 2 years. I was in charge of Toronto Dominion's international department. I am a U.S. citizen, though.
All right. Bernie?
I'm Bernie Krause. I've been a member of the committee for about 2 years now. Own a condo over on McKinley Ave, retired Army, Intel and Security. I've been working for Leidos for about 25 years, where I can do more of the same, and security engineering and auditing.
Great. Michael?
Michael Schaefer. I've been coming down to Dewey for about 20 years. My wife grew up coming down there and dragged me in, and loving it. Property owner in a condo at the Sunspot Condos, where I'm also on the board over there. And my background is property management. I have apartments and a mobile home park and a flooring company. So just like to make sure that books are in order, and love to be able to help make sure that we can keep investments growing for the town.
All right. So that's those are all the members of the committee. One note, we had thought we were going to have another member of the committee, Christine Cooper. She notified me yesterday she's not able to participate in the committee. So she was removed from the website as well, in case there are anybody from the public who might have seen her name before. She's not a member of the committee. Dominic, why don't you take a moment to introduce yourself as well, so everybody knows who you are?
Sure. Dominic DeFibo. I work with Brown Advisory on kind of the oversee and implementation of the investments. Have been with Brown Advisory for about 4 years in portfolio management role. We have our office is in Centerville, Delaware, and based out of Baltimore, Maryland. but certainly a global firm. I've been kind of working, I guess, with Dewey now for going on 3 years. It's been wow, 3 years. Surprising, time flies. But yeah, here to give an update. I'm on the portfolio and kind of a market overview of where we see things kind of going from here.
Great. Okay, so we've got the committee has 5 members and all 5 are present. So we certainly have a quorum as well as our commissioner liaison, Bill Stevens. So why don't we move on to the next item on our agenda, which would be to adopt the agenda. I think everybody has the agenda. It was posted publicly on the website as well as I sent it to each of the members as well. Do I have a motion to approve the agenda?
I motion to approve the agenda.
I second it.
All right. Any nays? Hearing none, it's unanimously adopted. All right. I think we just did a short introduction of each member, so we can move on to the next item, which is discussion and possible vote on a member to serve as the committee secretary to take minutes. Anybody willing to volunteer for that role to prepare the minutes of our meetings?
I'll take care of it.
All right.
Thank you.
We appreciate that, Bernie. Thank you.
2 years, what's another year?
Yeah. Well, it's not a heavy lift, but it is a chore. So we definitely appreciate you agreeing to do that. So do I have a motion to approve Bernie as our acting secretary?
Motion to approve.
And a second?
Second.
Any nays? All in favor?
Aye.
All right.
Aye.
Aye. Hearing no nays, that is unanimously approved as well. We can move on then, I think, to item 5 on our agenda. We're moving right along pretty quickly. Number 5 is a review and potentially vote on the previous meeting minutes, which I believe are also posted online and I had circulated in advance to everyone. I think there was a typo on the minutes, which has been corrected. It had referred to 2019. The meeting actually took place in 2020 as it's reflected on the current version of the minutes. But no other changes were made to them. Has everybody had a chance to review the minutes of the last meeting?
Yep.
Yes.
Anybody wish to discuss or make any comments on the minutes to the meeting? All right, then I think we can move forward. I know everybody, they're not long and everybody has had a chance to review them. Do I have a motion to approve the minutes as they're presented?
I move that we approve the minutes from the last meeting.
Thanks, Jimmy. Do I have a second?
Second.
Thank you. And are there any nays? All in favor of the minutes? Aye.
Aye.
All right, we have
Aye.
unanimous approval of the minutes
Aye.
as well. And I think we can then move on to the next item on our agenda, which is item number 6. Oops. Number 6, town manager's presentation of financial needs. Do we have the town manager presentation? I know the town manager was copied on the meeting agenda. Bill, do you want to at least give us a summary of the
Sure,
last meeting?
I'll give you guys a brief overview based upon my recollection. I'll apologize in advance. Decided to have the carpets replaced in my house.
Ah.
So the banging's not somebody trying to get in. It's somebody trying to make the floors a little bit better. So I'll be quick and go back on mute. After the review of the financial statements last month for the 9 months ending December 31st, 2020, the town of Dewey Beach ended up at roughly $530,000 in positive net income compared to a $289,000 budget. So we were well ahead of where we anticipated. And please remember that that budget was not altered as the effect of COVID. It was the original budget that was passed back in February, March of last year. If you looked at various line items of the budget, the largest single increase had to do with the estimated year-to-date transfer tax, which we were approaching close to $1 million versus, if I remember correctly, roughly around $400,000 or $500,000 for the period ending December 31st, with a total annual budget of roughly $650,000. The overall variances within the, if I looked at each of the line items, you'd expect everything matched actual to budgeted pretty closely, except for the fact that we lost enforcement related income associated with parking or dogs or just generally code enforcement, because we just didn't have the people on the streets during the summer, during the COVID. People had resigned, not wanting to put themselves at risk. We also, to that 200,000 or 300,000 we lost, we had an offset of roughly $80,000 in overall cost savings associated with not having necessarily that labor during the period. The town is doing remarkably well. I noticed in the minutes that we anticipated or thought we had prepared for $1 million loss in revenue, and we're looking quite good right now as we have the home stretch for 3 months left to exceed the budget. But I'll tell you that at the commissioner meeting as well as the budget and finance meeting, there is a general concern going into the 21-22 and not necessarily having a balanced budget, assuming that the transfer tax associated with the properties are going to cause a reduction in potential revenue in the following in the next year. That it was more of a timing issue versus an overall spike. To give you part of the metrics, Brian and team, we historically averaged between 70 and 75 properties transferring in the course of a fiscal year, and we had 83 for the first 9 months of the year. So we're looking for other avenues, and we're actually having a budget and finance workshop if anybody would be, would want to listen in, attend, etc., to talk about how to strengthen the financial security of the town of Dewey Beach.
Bill, one question on the transfer tax. So with the rise in transfers of ownership, and I mean, I assume everybody has seen the same that I have, which is seems that more houses are being torn down and replaced. Is the shift also to more single family homes that are not going to be part of the rental stock? And does that then further cannibalize potential revenue, since there wouldn't be rentals where there's a rental tax?
Yeah, Brian, there's definitely been that movement. I too, similar to you guys, I started coming here in 1989 when I graduated college. It just seems like it was yesterday, but it was 30 some odd years ago. I was one of those guys in the group homes that enjoyed Dewey Beach the way it was in the early 90s and tried to become an adult for a very short period of time that didn't last very long, and started coming back in 2011. And most of those group homes that even in 2011 have been teardowns. They have been torn down and much larger homes have built. So I do believe that will continue to be a trend. What we've seen is those teardowns are happening. There's a trend of obviously much larger homes, very few. What they're anticipating is in the next 4 or 5 years, there being very few group homes, especially for the pre-25s, and more weekly rentals in the sense of families. So there will be a transition. But on the flip side, Brian, we also have there's been a greater increase in the average price per home over that period of time also. So there's a little bit of a balance of it.
So it sounds like maybe at least with the newer, bigger homes, a lot of them will remain as rentals. It's just a different style of rental.
That's what we believe, but we're going to continue to monitor it because it is one of the few sustainable revenue sources that we've had over the past that's not looking after code and code enforcement.
Okay. So if I read you correctly, then the year that's coming to a close looks to be, we actually had a surplus in the budget, but going forward, there's concern for a deficit.
That is a very true statement. And so while one of the questions that was posed at the Budget and Finance Committee, which affects the Investment Committee, is to understand if any of the investment or part of the investment gains year over year on the beach fund could be used for general operating. And I have not had the chance to review the charter to see if that's a possibility. But that did come up as part of the initial Budget and Finance. We don't want to violate anything that's put in the charter in terms of the beach fund, in
Right.
terms of the basis, but just to understand if any of the investment income could be used for general funds.
Well, I mean, I think, I don't want to speak for the committee, but my view on the committee is that, you know, I personally, I'd probably be open to moving surplus funds, you know, to the extent that they're available and they're needed. But I don't view it as the mandate of this committee to make that decision. I would think that comes out of Budget and Finance, and obviously also the town council. But
Yes,
to the
of
extent
course,
we can
I
be
just-
helpful in
yeah.
that regard.
Oh, absolutely. I just wanted you to be aware of that conversation.
Yeah, okay, great. Do any of the other committee members have questions for Bill, recognizing he's not the town manager? And I know we have a brand new town manager as well.
Are there any projections regarding the turnover this coming year, sales of houses? Any valid type of projection or?
Yeah, you know, Dennis, we looked back over the last 7 years and we looked at the lowest amount and the highest amount, where the lowest amount was right around 600,000. Obviously this year it's going to be close to $1 million. So we're right now, the Budget and Finance has gone with the lowest possible amount, which was the 2014 number of around $600,000.
Okay.
Any other questions for Bill?
I would just like to bring up that I had asked a similar question a couple years back, sort of about what are, what should be the investment committee's, primary goals in terms of setting aside stuff for long-term versus, the possibility of having something short-term, so that there might, in case there's a need for the town to access the funds, and sort of what our charter was with that. And it was at that point mentioned it was still ill-defined, and we're waiting for. Again, the town to let us know sort of what those splits should be, because I like you. I don't feel that it's it's not for us to say, but for us to manage in the best way as they deem fit.
Yeah, and I would agree with that. And I looked back at the investment policy itself that's in the town code, and it states that, our mandate is effectively to manage the investments with the professional manager, which would be Dominic or Brown Advisory. But we are supposed to do it in consultation with the town based on the liquidity needs. So I think what we're missing is that ingredient, is knowing, well, what are the liquidity needs of the town? And I mean, I think it's pretty clear based on what Bill just said that there's a concern for potential short-term needs. So I think we get that. But we probably need to have some better sense of the budget projections to know how the funds should actually be allocated between or among the various investment funds.
And maybe we need to take it upon ourselves to meet annually with the budget group at a certain point each year, to sort of work in tandem to figure out what those short-term liquidity needs might be, and adjust things accordingly.
Yeah, I think that's right. I think that's a good suggestion. Other comments, questions?
Well, I think in the past years, it's been a lot more steadier, and therefore, it's better to anticipate the liquidity. But I think in this situation with COVID, right, that's what really kind of throws a wrench into the thing, and therefore, we got to be a little bit more flexible about the process.
Yeah, Jim, if I could just make a comment, the current budget is approximately 150,000 below a balanced budget. So the Budget and Finance Committee is looking for creative ways or sustainable ways to balance it at that $150,000 mark. I could tell you that our conversations internally are trying to not look at the town as a year-to-year performance, but we're here for the long term. So what are the projects? What do we need to accomplish over the next 5, 10, 15, 20 years? in order to achieve our goals as residents. You know, what do we want the town to look like in 20 years or be in 20 years? And how do we get budget and finance? How do we get investment? How do we get planning and zoning infrastructure all in line with that long range plan? So I think what we're going to see is more of an evolution of all the groups working together for that common mission.
Is there a long range budgetary plan that lays out, you know, sort of, you know, longevity and realistic use for example, property and structures, you know, what improvements the town wants to make over the long run so that it can be budgeted for in the investment accounts?
No, there has been a plan in place, but it needs to be a comprehensive plan.
Gotcha.
But it needs to be updated, and I believe it needs to be broken down into those investment structures, where are the restricted versus committed funds, how are you going to pay for it? It's something that needs to have a more detailed focus, to be honest with Brian. That's my opinion.
Yeah, I would share that opinion. You know, I think of the days when I used to run a condo association, and you know, we had a budget laid out, you know, 20 or even 30 years. We hired a consultant to come in and, you know, give us the projected uses and lifespan of, you know, things like the roof across, you know, all the buildings, and property management fees and property maintenance and landscaping and trash hauling, and, you know, would we have to improve things like, you know, repaving the parking area, and everything had kind of a projected, you know, period of time over which we had to accumulate the assets to pay for those things in the long run. And, you know, much like the town does, we had two different accounts, and one was short term, one was longer term, you know, sort of the savings account that we'd sock away the money for the long range projects. So I think getting that kind of guidance from the town as to, you know, what's coming up over the horizon would help us, you know, give guidance to Dominic as to where we want the funds actually allocated.
I think it's great, and I'll take that back to him. I couldn't agree more.
Yeah. So you know, historically, the investment committee has been charged with taking care of the funds, you know, the long-term funds that are to be used in case we need to replenish the beach, right? That's the biggest chunk. And obviously it's to be saved for a rainy day in case the government does not fund the replenishment of the beach. And Dominic, you know, you're around, you know, early on too. And really that was the whole intent of the investment committee. It did not get involved very much with the day-to-day financial operations of the town. Now, what it did was that it provided some short-term cash in order to allow cash flow, you know, through the year, because obviously funds are coming in the summertime from, let's say, tickets and things of that nature. But in the beginning of the year, there wasn't enough cash in order for it to run. So really, you know, historically, and it's not like I've been around that long, but that was really kind of how I thought the investment committee was set up primarily for. And I'm not saying that we can't change, but that, you know, that I think was a little bit of the history on how the investment committee was set up. Because again, years before, just if you guys didn't know, was that it was run very haphazardly, and there was even like some commissioners or someone on committees making investment choices on their own, trying to support, you know, the fund. And there were some very dangerous investments that I forgot the person. I don't remember all that, but it really, you know, and that's why we basically hired Brown to, you know, manage our funds in a safe manner. So I'm just kind of giving you a little bit of, you know, the recent history.
That's helpful. Other questions or comments? Well, why don't we then move into the next item on our agenda, which is to hear Dominic's report on the performance of the portfolio. And that might give us a better idea of what the free funds are that could potentially be moved as needed.
Great. Well, thanks everyone. It's good to see everyone. I feel like it's been a while since I've given a report, so glad to be able to do it today. And I think I can say that let's just go back. We'll start at the beginning of the report. I think as we kind of came through last year and we've had multiple discussions, I think in hearing what I'm hearing today, I think it's important that we do take a look at what the accounts are that we do have under management and understanding kind of, because I think it's helpful for me kind of thinking about kind of the long-term investment horizon here, and kind of the needs of the town. So we're managing kind of three buckets of money really. So first is kind of the long-term beach replenishment account, which is, to Jimmy's point, the largest portion of the assets. The short-term beach replenishment fund, and then the short-term general fund. And so to give a little bit of background, historically, the short-term funds were managed kind of using 3 to 6 month treasuries. These were meant to be super liquid, and kind of, as the last year, as kind of rates have pretty much bottomed out, and really getting kind of no additional income in treasuries, we've kind of kept it in kind of short-term money market. I think that's kind of my biggest, if I were to say, what's your biggest question? I would say let's try to come to some sort of conclusion on how we want these particular funds invested. And there's certainly some options out there that we can get some additional yield and some safe, short duration strategies that we can kind of, get some yield here in the short term. There was some talk last time about, combining the short-term beach replenishment with the long-term beach replenishment, given that the government has been stepping in and paying for beach replenishment. So why have kind of two funds here? Let's just combine it into one, and manage kind of liquidity and short-term liquidity kind of through the one, kind of the main long-term beach replenishment. So that's kind of a little bit of background, and I can stop and just open that up for discussion real quick.
Yeah, and I think this is maybe a good opportunity to sort of pick up the next item on the agenda simultaneously, because I think these topics sort of interrelate. What exactly are we supposed to do and how we organize or set up these accounts? And I went back and looked, and I think we may need to do some revisions to the actual investment policy, or at least suggest them to the council for approval. One of the issues is that Chapter 24, which is the official investment policy, only speaks of two funds. It talks about a general fund, which is for operating and capital improvement, and two, the beach replenishment fund. And then under our implementation plan, which is designed to implement that investment policy, we have the three accounts. We have a general fund, and then we have two distinct beach accounts, one short-term, one long-term. So I think to Dominic's question, do we need two separate accounts for the beach replenishment fund? And, would we gain, sort of a threshold question for me, Dominic, is would we gain any economies of scale or efficiency by just combining it into one account? And whatever we decide is the sort of the short-term component of it, we can allocate more toward cash. But is there any advantage to having one account versus two accounts?
And I mean, the short answer is not really. I mean, I don't mind managing it in two separate buckets. It just kind of feels like, you're getting additional statements. You're getting, it's just like a cleanup almost, if you will, right? It's just kind of, how can we clean these accounts up and make it kind of as efficient as possible?
Yep.
And kind of add that into kind of the overall asset allocation with a potential for higher return. In the bigger picture, it's kind of like, if we don't need it, we can always manage it through short duration, fixed income within kind of the long account, and just kind of call it beach replenishment, and get rid of the kind of the short and long term language within the titling. But Yeah, I mean, I think it would be more efficient, and I think it would be long-term probably better for the growth of the portfolio.
Would it also allow us to be maybe a little more nimble with how we invest the beach replenishment? So as the markets are more favorable, we can push a little bit more into the equities. As the
Yep.
markets look like they're getting more volatile and we want to pull back, we just shift the allocation within that one account, as opposed to having to operate two accounts independently.
Right, and I think you also have one investment policy. You just have one policy at that point too.
Right.
I mean, I think that's cleaner for the town. And I think to your point, I mean, we certainly have been nimble over the past year, and certainly are kind of overweight equity, and I think performance has kind of shown that was a good call, and certainly. Well, we can get into that, but to your, I don't know if you want to open that up for further discussion or not.
Yeah, I mean, we'll limit it for the moment, maybe to just this one question of, do we need two separate beach accounts? I'm not familiar with the history of why it was created as, other than what Jimmy has described. How did we get two accounts in the first place? And what is the allocation split between them? I mean, is there a mandate that says X% goes to the short term versus the long term? Or is there a minimum amount that we viewed as needed to be in the short term account?
The replenishment accounts have always been a political situation.
Mhm.
I'll just leave it at that. I was on the audit committee, and I mean, I don't know what we can do legal, maybe we were required to have two accounts. I don't know. So we
Yeah,
should
it
check that.
doesn't-
I'd rather have one account.
Yes, as would I, for all the reasons Dominic said. I mean, it's just more efficient. And I think potentially we could manage it a little more nimbly and hopefully increase the returns. But I don't know.
So,
I don't know if there's anywhere else in the town charter. I mean, it's not in the investment policy charter. The investment policy charter only speaks to having a beach replenishment fund. It doesn't talk about two separate mandates for one short term, one long term for that particular fund. I mean, it really describes it more as a long term. It describes it, you have to have preservation of capital, preservation of principal, and maintaining liquidity. So it kind of gets those two concepts of short and long term, but doesn't make any prescriptive requirement one way or the other.
Well, maybe Stephen should pass it through the commissioners. Just talking it. Somebody, it doesn't raise a red flag anywhere, but I'm for one account.
Yeah, I was just going to say, guys, I read through the investment policy. I read through the directive. I don't see anything in there, nor from being a prior member of the audit committee, anything that came out of the audit's perspective of needing multiple accounts on the short and long. When I read through it, I see that there is a different appetite for risk based upon those funds. And as you said, Brian, from a fiduciary responsibility to make sure that the funds are, maintaining adequate levels of principal, not overstepping our risk portfolio. But I will make that note to the committee or commissioners to inquire as to if and why we have three, and if we can go to two separate ones, one for beach, one for general.
Yeah, I mean, I would, to put it sort of in simplest terms or distill it down, I view the general fund as shorter term or short term, and the beach replenishment fund is a long-term fund. We should maintain some measure of liquidity and shorter term investments in that other fund, but generally its focus is longer term, period. I mean, it's not an operating account.
Agreed.
Yeah, and I think the
Any
overall
other thoughts on that issue before we let Dominic move on to the rest of the presentation?
yeah,
Okay.
okay.
Well, great. So just kind of give an overview, and typically like to just kind of give, performance overview of the long account, kind of followed by asset allocation, and then kind of give you just some overviews of kind of what we're seeing kind of in the markets that I think are interesting, and probably certainly relevant for this, as I typically talk about equities and kind of equity markets. I think we have to look at our fixed income holdings here and kind of returns moving forward given this low interest rate environment. But here in the top left of this page, the performance last year. So the portfolio was up 9.3% last year, which on a 70% bond portfolio, 30% equity portfolio is a heck of a return. I think we were very pleased with kind of our what our managers were able to do last year, both on the fixed income side and on the equity side. And so really kind of really happy with overall performance. And so inception to date, the portfolio is compounding at 4.7% net of all fees on an annualized basis. And so I think overall I would say it's a good return given kind of the risk profile of the overall portfolio. So on the top right, to my earlier point, we've certainly been light on cash and light on bonds, and really have done that purposefully. Cash, obviously, as we just talked about, is really earning in this environment not much, and so we certainly don't want that to be an overall drag on the portfolio. And given kind of the no need for any type of kind of disbursements from the account. No need to really have a large kind of cash position within this account. We did underweight fixed income last year and leaned into equities, and that has done well. We've also obviously with kind of equity appreciation that has also kind of driven up equity values. And so, there's some of that is just some of the underweight of fixed income is really because of the equity appreciation. But kind of feel good right here. And there's a couple pages in the back that kind of talk about kind of where we are from kind of an equity valuation standpoint, and relative to kind of our forward kind of looking returns for kind of investment grade bonds. But as I always like to show,
can I just detour for 1 second,
Please.
Dominic,
Yeah.
just to compliment you, because I'm just looking up historical returns of some benchmarks, and the 1 year return on the Barclays U.S. Aggregate Bond Index, 7.51%. S&P 500 is 18.4% for the trailing year. But I mean, our portfolio looks like it's 70% weighted towards fixed income. So you've, with not a lot devoted to equities, you've gotten a nice little bump in the return over a bond fund. So nice job.
Thank you. And that's, look, I mean, it's our team. It's not just me. Certainly a lot of other people on the team that I work with that help out in this. So. And as we always do, we always kind of give you kind of the underlying investments and kind of their relative performance versus the underlying benchmark. So the Brown Advisory Intermediate Income Fund, investment grade bond fund, really the core of the portfolio, and it's kind of kept up, right? I mean, it hasn't knocked the socks off of anything, but as you probably realize, it's beating an index in bonds is not the same as beating an index in equities. And so it's much harder to beat an index. But keeping up and given kind of the quality bias of that portfolio and given the big drawdown earlier in the year, feel pretty good about kind of we were able to kind of gain a lot back throughout the year and really leaning into some high quality credits and really being able to kind of get back some of that return that was lost earlier in 2020. On the equity side, our flex equity strategy has continued to produce really stellar returns over and above the S&P 500. As you can see, since inception, the flex equity portfolio has beaten the S&P 500 by 1.3%. On an annualized basis. So quite significant outperformance, and we continue to but they continue to be very disciplined in their investment strategy, continue to be very concentrated, and really kind of having a really kind of a core bias, core to growth bias, but certainly not kind of a full kind of growth portfolio. Really believing in buying good companies at good prices and holding them for a very long time. They're very, very long holders of businesses. I would say it's a very much a buy and hold type of strategy, and has performed well. I'm going to come back to the small cap.
Numbers gross or net?
They are all net of fees.
Wow, that's
All net of fees.
an impressive portfolio.
And so I'm going to come back to the small cap value fund, because we've talked about that before, and I really want to address that because I think it's worthy of addressing given the volatility in that asset class. But on a global front, look, we went last year, and we kind of did this across quite a few portfolios, really having kind of a less of a focus on Europe and IFA and international. Really an asset class we just didn't feel had a lot of growth. There was a lot of structural headwinds facing kind of European Union and with Brexit and some of the other factors, negative interest rates and to name a few. And so we really looked for kind of global managers to really be our kind of core kind of international type of strategy. And so we bought kind of global leaders in April, and has really returned. It was a great returning investment for us. The strategy was up on the year. Our team, it's an internal strategy at Brown, and they just presented this morning. I thought I'd share a couple of slides from that. Just I had it and I thought I might find it interesting. So the strategy for the year was up 16 and was 17%. Relative to its benchmark was up 12.2%. They did that through capital allocation and investment selection. And so that's kind of the breakdown. And this is kind of how you can see. Sorry, this is the 5-year annualized performance. I apologize. That's not 2020. But this was the 5-year. This is the 5-year performance. So over time, they've done really well, and it hasn't just been from stock selection, but it's also been from capital allocation, which they spend a ton of time focused on. Some of the metrics and attributes of the portfolio, which I always find interesting. They're very focused on what they call ROIC. There's an Australian manager and an English guy, and so they really focus on kind of return on invested capital as their main driver of portfolios, and certainly want to capture as much of the upside as possible with minimizing kind of downside. So we always look at that on the right side here, kind of upside downside capture. So getting 109% on the upside and only 86.6% of the downside, which is terrific and certainly why they've been as successful as they have. This is kind of the long-term performance of that strategy on a year-by-year basis. So up about 21% last year over the benchmark, which is up about 16%, and have annualized, had quite significant annualized outperformance over their benchmark since inception back in 2015. We'll kind of move on from there, but I just thought it was interesting to share, and I knew we're talking today, and that the town owned it, and it was worthy of sharing. Brown Advisory Emerging Market Select Fund has also performed well. There were parts last year where emerging markets was trailing. As a reminder, this fund is made up of actually 2 different strategies. It is made up of 60% is Wellington Asia strategy. And the other 40% is Tazina. It's a emerging kind of a broad-based emerging market value strategy. And we've used to be 50-50, and we've kind of sized it up in favor of Wellington is international. And really our view is that there's certainly more upside, more opportunity kind of in emerging Asia, given kind of the population, the demographic growing middle class and so on and so forth. And so we've kind of sized up, that portion of and it really showed through the performance as Wellington had a very strong year. So the other two accounts, again, in cash. And so really, I think one of my other questions would be around the general fund. And so what do you want to do with the general fund? I mean, it's $1 million sitting out there. And I can certainly provide some options, but I think we would have to amend the investment policy statement, because I think right now the only thing it allows for, my understanding, is short-term debt instruments. I think less than a year, if I remember correctly. And so that's up to the committee, but I want to present that and just say, what should we be doing here? Are these funds needed? Are they going out anytime soon? And maybe getting a bit more color around the general fund.
Yeah, I mean, I think that's an important issue, and one issue that it has sort of puzzled me is the relationship between the general fund and the operating accounts of the town. There's also, separate from this managed account, there's also an actual operating account. And do we need this much conservatism in the general fund if there's an operating account that gets funded, periodically, as revenue comes into the town? I don't know the details on the other account, so Bill, if you have thoughts.
Yeah, I'll let you know. As of the end of December, our general fund balance was just over 1.5 million. So, theoretically, we have roughly 40% of our annual budget in cash from an operating perspective. One of the mandates put out to the Budget and Finance Committee was to finalize a general fund balance policy. So to know where we are at any point in time, to take excess and putting it into our investments, and or if we require the liquidity coming out of the investments, that we can use it. The last conversation was approximately 6 months, so we're not far off from hitting that general fund, but we do need to finalize. But as I said, as of December, we had 1.5 million in the bank heading into the next season, so we're in good shape.
And is there revenue added monthly, quarterly, annually? How does the money get into that account?
It is purely through, it is the monthly operations. It's purely through the various buckets, whether that be the transfer tax, the accommodation, code enforcement, parking, etc. There has not been a draw from I believe that Dominic, you can to attest to, I don't believe that the town has withdrew any of the funds from the Brown Advisory account. So we have not had to rely upon that. So that is actually in addition to the 1.5. So if I think of the self-committed funds plus the general fund, we're at roughly 3.5. So we almost have a full year of operating cash already in the general fund.
Would it make sense? And again, this is just an idea. We have done the long and short type of fund for the beach replenishment. We kind of understand the differences there between the short and long term, as we've already discussed. It might make sense to have a portion of this kind of more for long term, to try to somewhat grow some portion of this, if it's 25%, just kind of thinking more long term, and given some of the things, Bill, that you had mentioned, just in some of the potential shortfalls coming up over the next couple of years, or projects, Brian, that you mentioned, maybe looking at a 5-year plan, and maybe some of that planning could inform us a bit better. But you really investing some of these dollars to really help the long-term viability of the town.
Dominic, I think it's a great idea. I think it's a great idea to look at in terms of, what does, a short-term portfolio look like? Is it that we need to have 3 months of operating cash in cash and equivalents, and the balance into a portfolio of some range of equities? I think that's a great idea. it makes sense from a total return perspective also.
Who would be managing it? The investment committee or the audit committee?
I would assume it's the investment committee does.
Okay.
Brian, do you agree?
Well, I mean, I think the investment committee would act on whatever mandate comes from
Yeah.
the budget. So we'd have to know, what is the short-term requirement of the town, and then, what is an appropriate cushion? How much liquidity do you need? I think that comes from the budget, budget and finance. Once we know what that is, then we can give instruction to Dominic or spell it out in the investment implementation plan, how we specifically want to meet those needs. I mean, in my view, if the town is already sitting on a 6-month cushion and revenue continues to come in on a rolling basis, a 6-month cushion in the actual operating account, the daily account, is a reasonable cushion. So the rest of the money should be invested. Doesn't mean it should be invested like the beach fund, which is long-term. But I mean, I think we're leaving money on the table by investing the general fund too conservatively.
Yeah, I think that's that's my sense as well. And I as an investor sitting here, it's tough to not be investing it. But I mean, I completely understand where it's come from, and understand the history. And so I think it's just important from a fiduciary perspective to continue to bring this up, reevaluate on a yearly basis to see kind of where budget and finance is at the current time. And then evaluate things kind of on a yearly basis, as we should do with the investment policy statement, as we're going to do today, but kind of in line with all of that. Thinking about just really thinking about getting it invested and thinking about the total return of that fund.
Yeah, I mean, I think of sort of basic investment thesis is, what is our short-term liquidity and requirement? And short-term liquidity is, there's day-to-day operations, and then there's the rainy day backstop to that. We've got a 6-month lead time in the daily operating account. How realistically is it that we're going to have to call on this we'll call it a short-term general fund to provide a backstop to the daily operations? And some portion of it should be set aside as true daily liquidity. I mean, if a meteor strikes the town, we need to depend on this account for that short-term backstop. Money gets depleted pretty quickly, but it's definitely not 100% of the account.
Right. So if I can ask a question, as I look at this performance, Dominic, and I look at the asset allocation, we're currently at 100% weight on the general fund short in cash. And pursuant to the investment policy, the range with cash equivalents was 20 to 60 and range 40 to 80. Is there any reason why, given what is in the investment policy, that we don't take a more proactive approach to balancing it to the policy? Does that make sense? I'm not sure why we're 100% in.
Right, and like I may have mentioned earlier, that's where we were previous to rates. But when 3 and 6 month rates, and I can pull them up, but when they're at 20 basis points, it's like you're getting that. You're getting that in the money market. Like what?
Right.
So we were doing that. We originally, when I first kind of took over this account, we were in 3-month treasuries, and we went to T-bills, and then we went to 6-month just to gain an incremental. But that was at a point in time where rates were kind of continuing to rise and rise at kind of 3-month clips. And so we were kind of ticking up every 3 months and kind of getting that extra incremental yield. And so that strategy worked really well. But on the other side of it, we were then in 6 month, and then rates started going the other way, and now we're at kind of at the bottom. Now, if look, I mean, I think the Fed's going to continue to probably keep rates low. I mean, they may
Mhm.
naturally kind of start to tick up as a 10-year. We've seen the 10-year over the past few months kind of tick up. But, you know, short-term rates are going to probably stay about where they are. I mean, the Fed has kind of said that they're going to keep rates low. And so I think that's my greater point here is, you know, those type of investments are just not going to get us anywhere. And so I don't know, Brian, if you had any.
Yeah, I mean, I thinking about what the investment options are, and this needs to be spelled out in the policy. But you know, there are, say, T-bills, very short term. But then, you know, fixed income could also include, you know, a mutual fund or an ETF that's fixed income based. It has all the liquidity you want. You get daily liquidity in those products. But the funds themselves, internal to the funds, they're designed for longer duration, and maybe you get a little bit more alpha. So I think we could get away from being truly in cash and get higher returns just by changing the product mix.
Yep.
Yeah, because you know, what sticks in my mind, Brian, is your prior comment of how well the fixed income is done in the beach replenishment long.
Mm-hmm.
And, you know, looking at a trailing 12 of 5.4 and a, you know, trailing 3 of 4.2. And, you know, that's investment income that we potentially could have received in the general short.
Yeah,
to the tune of, you know, 40,000 more a
sure.
year.
And to that same point, like if we, you know, if the meteor strikes the town, you still have daily liquidity in those funds.
Right.
So why not take advantage of a better return? It's still not jumping, you know, into the deep end of equities where you're getting a lot more volatility, but you're at least getting a little better returns.
Yeah, and what we've been doing in kind of in this environment is wanting to kind of lower overall kind of duration as given where rates are, and so we've certainly done that in some portfolios, and so we could kind of manage our kind of overall duration through what you just said, Brian. We've been using, I mean, a lot of really low fee Vanguard. I mean, they have some short duration. They're
Sure.
safe. They've been tested. You know, we back tested them versus kind of the credit crunch in March. They fared very, very well. One of the safest investments that Vanguard has from an overall perspective. So, yeah, they're not going to probably get you 4%, but even if we can get, you know, 1.5% yield,
Yeah,
is better than where we are today. And I think overall that's going to be better for the town. So,
Who would make the decision that would allow us, or that would allow this money to be moved from basically the Budget and Finance Committee or the cash position to us?
you're talking in the operating account to us?
Yeah, the operating account, some of it, or, you know, to us.
Well, I don't know. I mean, I guess that's an open question. I wasn't proposing to move the operating account to here.
The excess in it.
But the excess beyond whatever the agreed, I think Budget and Finance has to determine how much money do they need in the operating account. You know, money that literally is only in cash because they think there is a need to maintain, you know, X number of months of cushion to pay the bills.
Yeah, Brian,
Keep the lights on. Yes, Gary.
that's Gary Forsinger. I'm sorry I couldn't join earlier. Just by way of history and in terms of the general fund balance, the auditors for the last couple of years have recommended that we have a general fund balance policy. We tried to do that last year, working with Scott and some of the council members. And the auditors took a look at that and they said, basically, nice try, guys, but you didn't quite get there. And so we still have a policy on the books that we need to revisit. The auditors have pointed us to some guidelines in the Government Financial Officers Association. They have some specific guidelines for how to set up this kind of policy. They even have an exercise that you go through to you know, look at the various types of risk that a government might face in the future. so that you begin to judge how much money you really think you need. So it's kind of in the lap right now, not of budget and finance really, but in the lap of the audit committee. And I think the problem is we need help. I don't think that there's the right kind of expertise right now on the council. Bill may be able to help more than others, but I think we need some help. Maybe there's some help on your committee. There may be some help on the audit committee. We may need to put a set of people together to really work this thing through so that we can put together something that will satisfy the auditors the next time through. And then I think there's probably a lot of flexibility for making some recommendations about what to do with the rest of that money that will be left in the general fund account.
Yeah, Gary, I think what you bring up is the intersection where investment, budget, finance, and audit all come together and are on a consistent approach.
Yeah, I think that's right.
And one of the where this comment particularly was in looking at page 7 of the portfolio overview, where the town has developed an investment policy on the general fund and beach fund from a short term, looking at roughly a 40% target in cash and 60% in fixed income. But yet currently we're right now at 100% cash versus fixed income, and how historically those allocations may have changed. So if you have any insight into the history as to why it's not 40, it's 100 versus 40/60, I think it'd be beneficial.
I mean, I can.
Yeah, Dominic.
I can give some color there too. I mean, it was, Bill. I mean, it was 60/40, and that the fixed income was defined as kind of basically owning treasuries. I mean, the mandate and what the committee had determined was to own 3-month T-bills, and that was the instruction when I started. And like I said, the fixed income portion was T-bills. And so we're now in this environment, this low rate interest rate environment where things have just changed, right? And so that fixed income portion, I'm just saying, we can keep that allocation, that 60/40 allocation the same, but the instrument in which we invest in, needing more flexibility for the instrument in which we can invest in.
Yeah, I mean, the two historically in the near term, the two different buckets of cash versus short-term fixed income are giving the same returns. So you might as well take the even shorter duration, which is money market.
Right.
That's how we got to the 100%. I think what we've been discussing is, can we expand the 60% bucket, since short-term treasuries don't do us any good? Can we expand it to more fixed income? And I would suggest it's a good idea because you're still getting daily liquidity. You're not taking on that much more risk. You're still staying in fixed income instruments. You can still get daily liquidity in a fund, but you can get exposure to something that pays a little better returns than what we're seeing now. But I see the predicate that we haven't answered or don't know the answer to, and I think, Gary, this is what you're getting at, is we don't know what the short-term requirements are to know what the proper allocation of the funds should be for the money that we do have in the bank.
Yeah, I think that's right. And, when we try to do that fund balance policy over the past year, we had Scott Coney working on it. He doesn't have he's not an accountant or financial guy. I'm not either. We kind of dabble around the edges, but, again, we took the best shot we could, but it clearly fell short. And so we really do need some help. And I think, as Bill said, there may be a ready intersection here between 3 committees. If we could get some people from each committee to kind of work through this exercise that Government Finance Officers Association has available, we can probably get to a point where we understand what those short-term needs are, and then can move on with the rest of that pot of money and to make some good decisions about how to use that pot of money and how to invest it.
Yeah, I think that's the right approach. I mean, the order of operations, as I see it, is what is the annual budget? Start there, and I don't even know what the total annual budget is.
It's about $3.5 million or so, I think.
So we know every year we need about 3.5 million, and it gets reevaluated every year, obviously. Next question is, okay, well, what is the short-term need that you have to keep liquid to meet that budget? Do you need to have 6 months in cash? Do you need to have 12 months in cash, or some other number? Once we know that, then we know that we need, if it's 6 months, we need 1.75 million sitting in cash. Everything else gets invested. And then we can make a policy decision as to the everything else, which would be, well, we've got 6 months in the bank, but we still have to worry about a meteor striking the town. So maybe we want short term to be another 6 months worth of the portfolio. But then longer term, anything else just moves into the longer term bucket, and we invest it and try to get a return on it. But we're missing that predicate step of knowing what is the short-term need so that we can properly allocate the rest of the portfolio. So I think we're gonna, I guess I would propose, based on Gary and Bill's comments, that maybe we should have a joint meeting among the 3 different committees to try to crack that nut of what is the short-term need, and then from there we can figure out the proper allocation.
Yeah, Bill, I'm wondering, we have the February meeting coming up. Maybe we could make a proposal or include an agenda item to talk about this and a way to approach this, because this is, I think, in terms of the finances of the town, this is a key fundamental question we need to answer. And if we get the right people together, I think we can probably do it in, fairly short order, I believe.
I agree, Gary. I think it's one of the town's assets, one of the town's possible solution to gaps that we're going to have financially in the future. So I think it's a great idea.
Okay.
Good.
And taking notes.
Good.
All right, Dominic, you want to carry on?
Yeah. I'll just kind of. I know we're probably running long on time, so I'll make this quick. But really want to just kind of give an overview of kind of where we are, and I think this does a good job. So look, we coming through kind of Q4 of 2020. There was certainly some positive news around vaccines. Certainly the fiscal stimulus, from Congress really supported, risk assets into the fourth quarter. We saw, certainly a market rotation where kind of growth stocks had really continued kind of through most of the year, kind of that offline to online trade, work from home trade, really led the market in the fourth quarter as kind of, people kind of saw the light at the end of the tunnel of reopening with a vaccine. Value stocks really kind of took off. Certainly heading into this year, there's still rising concern of COVID. I think we're probably likely and still in some dark days ahead, over the next at least 2 months, as places are going to continue to lock down, and we're still seeing kind of, rampant spread of COVID-19. I think, as interest rates, and it says here interest rates rose, modestly. They did over the fourth quarter on the long end of the curve, and we saw kind of the overall Treasury curve continue to steepen on the fourth quarter. And look, we know the Fed. I mean, Jerome Powell said, he's likely to keep rates low for a longer period of time, and so that certainly does favor kind of risk assets and equities. And so, taking risk is certainly being encouraged here. I think as we look at kind of what are we optimistic about? Certainly, vaccines are at the top of the list, as we want to get economy kind of, boosted back and creating more jobs and getting people back to work and economies open back up. There still remains a lot of cash on many corporate investor and household balance sheets. Look, I mean, I think we can say that, innovation remains strong in the US, as we've seen a lot of people kind of in this kind of transitional period where maybe they lost work and are now starting their own job or working from home doing something different. And so you're certainly seeing quite a bit of innovation out there from an individual perspective. Some of the things that we're concerned about. I think the biggest thing in my mind is really, kind of public debt levels really at really unprecedented kind of peacetime highs. Debt to GDP is quite at a historic high, and we haven't seen these kind of levels in outside of wartime. There is going to be kind of an increased regulatory scrutiny. We have obviously an incoming administration coming into Washington. There's certainly going to be increased regulation, likely within the technology sector. I think that's where that goes, we don't know, but certainly it's certainly being talked about and top of mind of politicians. Look, we're still going to have continued geopolitical tensions between the U.S. and China. Certainly, U.S. and Chinese corporations are continuing to kind of be within the headlines, and will certainly be of concern. To that rotation, this is kind of shows that rotation from growth to value, and this is just kind of fourth quarter. So on the year, large cap value index was up 2.8%, up 16.2% just in the fourth quarter, as a lot of these value companies are really tied to the reopening of the U.S. economy, and certainly small cap stocks, small cap value stocks, up 33%. As we kind of look at, where do we go from here from an equity perspective? If you had that incremental dollar to put to work today, what would that forward return kind of look like? And I think this does a nice job of just kind of showing kind of where we were back in late March, really at the bottom. And this is based on the S&P 500 cyclically adjusted price to earnings ratios. And so, given where we are today, which is here, which is about 33.1 times, we're pretty far out on the curve, which really just points to kind of a low return profile kind of going forward. And this, again, we don't have a crystal ball. We only have the data that we can analyze. We don't really know where things are going to go from here. But this just gives you a sense for stocks are pretty expensive. A lot of the cash that has flown in from a stimulus perspective has certainly boosted valuations on a lot of kind of the technology sector, tech, med tech, and some of the other sectors. This just gives kind of like earnings expectations. So as we kind of come into 2021, what are we expecting versus where we were in 2020? So as you can see, obviously the biggest impacted sector of the S&P 500 was the energy sector. We've already started to see a rebound. Energy prices have rebounded quite significantly. And we're not heavy energy investors. Most of our strategies don't hold any energy exposure at all. And given just the overall volatility of that space, it's tough and certainly really hard to pick winners in that space. Industrials, another area heavily impacted, certainly looking to see quite a bit of rebound here in 2021, as well as consumer discretionary financials. We've seen that pop in financials already this year, and certainly we'll continue to probably see some rebound from that sector. This is, I think, a really interesting chart that kind of raised my eyebrows when I first saw it. The improving economic sentiment has really allowed kind of households and corporate balance sheets to really have higher kind of cash levels. We certainly think that the rebounds, and you can see that on the left-hand side, it's a little busy, but we expect rebounds kind of across the board as vaccines are released. Given kind of that's astonishing. The economy overall has $3.2 trillion in cash. And we can see that through bank deposits, money market assets, and corporate cash. certainly there's a lot of pent up demand. And so that should overall benefit the U.S. economy kind of coming into 2021 as we see things open back up. So I think that's important too, from your perspective as the town and thinking about, budgetary decisions and what's the summer going to look like. I mean, I think all things point to probably a continued, I would say people continuing to buy houses, continuing to see people buy a second house, given the ability to kind of save over the last year. And certainly people are going to continue to spend, and there's going to be certainly an appetite to want to go to want to go to the bars and do it, want to vacate rent houses and do it, and want to buy houses in your area. So I think that's all. They're all good things as you all are thinking about the upcoming year. So yeah, I mean, I think this is the one thing, as we think about the bulk of the assets in this low interest rate environment, it's going to be tough, right? I mean, bond returns, and I have kind of our Q1 every quarter. We publish our kind of forward-looking estimates, return estimates, and I think this is kind of highlights investment grade fixed income, and this is based on kind of as of 12/31 where rates were, where equity return, where equity valuations were. What does the next 10-year return look like on an annualized basis? And so investment grade bonds are really only expected to, if you were to invest today, to really 1.6% annualized year over year. And so it's not a lot, right? I mean, I think that's what we're thinking about here. It's the fixed income market has certainly changed quite a bit and allowed it to be more. It was interesting. I was just reading an article today. One of our head of fixed income investments on the institutional side posted just how the market has changed is quite drastic, and it really is allowing kind of more trading in and out of fixed income instruments, and where before you could lever up before, pre-2008, lever up, get the spread between credit default swap, using kind of leverage. And obviously that's a big part of what blew up. And that has evolved. And we're now in this day where, bonds are kind of somewhat traded like equities, and fixed income managers can kind of buy and sell, and market makers are able to kind of, provide kind of more real-time pricing, and that makes sense. It's a bond market. It's not typically the most sexy market in the investment landscape, but they can, even in a rising rate environment where you would say bonds, rates are rising, bond prices are falling, given that inverse correlation that they have. But we've been able to continue to continue to kind of increase kind of credit quality, as every one of our bonds is really fundamentally driven. And so, and really all I mean by that is they're doing all of the work. Our bond analysts are doing all the work kind of at the company by company, credit by credit level, to really kind of, buy bonds at a discount, and get some of that appreciation. And as rates rise, continue to kind of turn over the portfolio to be able to capture some additional yield and return, as they really think about total return, not just income from the bonds. But we're in an environment that is tough, and it's going to continue to be tough. And so we certainly will keep an eye on this, keep giving you kind of reports of where kind of the bond market is going forward. But I think overall we understand that this is really a stability asset for the town. And so our job and our mandate is to really have high quality fixed income instruments that are going to be kind of a preservation of capital. And so that's what we'll continue to do. So this is a good slide. I mean, in some of these slides, there's a lot of, we put an addendum in here for y'all to kind of look at, just some interesting slides that we put some of these slides here as a firm we put together. But kind of my team, we kind of, as we're going through and reading different research and stuff, we tend to just pull out charts that we just find interesting. And so I'm not gonna go through all of this, but I think this is kind of interesting. The chart on the right, so essentially the blue line, and again, these are somewhat hypotheticals, but the blue line just says, the extended period of low rates would likely result in steady but slow cumulative returns for a portfolio of short duration. So short duration kind of continue as rates go up, continue to kind of roll into kind of higher yielding instruments, and so that would be kind of a slow and steady tick up in cumulative return. However, if rates rise over the next few years, there is downside risk to the bonds owned in the portfolio. But will likely be kind of quite small, and returns could potentially accumulate more rapidly, as rates kind of start to normalize, and the bonds start to kind of outperform. So it's an interesting chart, and you could look into it multiple ways. But it just shows that if you're long-term focused, which this portfolio is, there could be some short-term downside risk, not a lot, but over the long term, the bonds will appreciate and you will have continued return in the future. So, it's a long-winded way of saying, we think, certainly equity valuations are a bit stretched right here, especially in the U.S. large cap side. We continue to see this rotation from growth stocks into value stocks, really for good reason, as value stocks were pretty hard hit last year and are on a relative basis pretty cheap. And we continue to watch fixed income in this low rate environment. And if we see certainly, one thing that would push is, given all the stimulus, we're certainly keeping an eye on inflation. The old I word, inflation. And so that could certainly push the Fed to raise rates sooner than later if we get more stimulus into the economy. And the economy, given all the liquidity on kind of personal balance sheets, will we see inflation above kind of Fed target? And so all things we're watching, all things that we're just kind of eyeing on a day in and day out basis. I don't think overall, the position in the portfolio really needs to change. We've already been underweight fixed income, kind of coming into this, overweight risk assets in the portfolio, and that's certainly helped quite a bit. I'm just going to stop there. I probably talked way too much. Any questions or concerns or things you want to see different or?
No, I think this has been super helpful and very interesting to see as well. I think, we obviously have some homework to do on our end to figure out what the investment policy should say in terms of allowable allocation. There seems to be an awful lot of opportunity, particularly as the market is improving. I sometimes question the exuberance or irrational exuberance of the market right now. It seems like there's an obvious disconnect between how the market is acting and how the actual economy writ large for most Americans, what their experience is. So I guess I'm a little circumspect about what's coming up over the horizon, but I do see a lot of opportunity if we're careful about it. I think we have to address the short term, and what, I guess maybe a simple question. Well, the question's simple. The answer I know is not, but is what are our alternatives to the short term? The bond yields are so awful. does it make sense in a short-term fund to try to increase the returns by going into some modest amount of equities, or should we only be looking at equity portfolios, but maybe different duration and different credit quality? Like, how do you address something like that?
Well, I think, I mean, I hate to put it in this way, but I mean, I really look to the committee to kind of give me, I mean, we certainly have all of the investment, we have all the colors on the palette to build any portfolio that you within your investment policy statement. So we can do that from a duration perspective. We can take a look at overall duration. We can use multiple strategies to kind of lower duration, increase increase yield. And so we're doing that for lots of different clients. And like I said, we've been using some of the Vanguard strategies just to lower overall duration of portfolios. We're actually launching a short duration strategy, I think, in the next couple months internally as well. But I like, the Vanguard's like 10 basis points or something fee on it. And it's yielding, I think, like 2.25%, or no, sorry, 1.25%, with a duration, I think, less than a year. And so, that's hard to beat when you really need it to stay short term.
Right.
I'm a little hesitant to kind of take an equity allocation right here, right now.
Okay.
But I think by the time the committee kind of comes together and makes a decision, we can always dollar cost average into equities in some portion,
Right.
And keep it really straightforward, really simple, super high quality from an equity perspective. Same on the fixed income side, keeping it investment grade, short duration, and really just focusing on kind of quality. I mean, that's, again, not knowing what the percentages are of the allocation. It's hard for me to really make a recommendation on the spot.
Yeah.
But I can certainly show you the options, and we can work together to build out that portfolio, whatever's decided.
Yeah, and I almost feel like the question is not even so much the percentage allocation, it is knowing what is the sort of the gross amount that we need in short duration.
Yeah, I mean, somewhere along the lines that 60-40 allocation came up.
Yeah.
And that was determined. So, 60% short duration fixed income, 40% cash. If that still holds true, we can certainly continue to use that as our.
Yeah, I'm not sure we've gotten to the point where it would change dramatically, but knowing the size of the corpus and the relative need short term of that corpus is relevant. I mean, a 60-40 split, if we had $1 billion in the bank, might not make any sense, whereas a 60-40 split when you have $10 million in the bank is perfectly sensible.
That's right.
I don't have a handle on the budget side to know how much of it really needs to be in the short term bucket.
Yeah, I
know you don't have that answer.
I defer. I defer to you all, but look, I mean, we can take this anyway. I mean, I'm flexible. We certainly have all the investments kind of at the tip of our fingertips to utilize to kind of help you all as a committee, build out kind of whatever you're looking to do. If you want to include me in any of the discussions, I'm happy to get on, happy to leverage, other folks at Brown Advisory to the extent I may not have an expertise to bring in someone else, perhaps from our strategic advisory team. We have strategic advisors that have expertise, mostly all kind of former trust and estate lawyers, but certainly have a lot of expertise in taxation and financial planning and modeling. And so, you know, we, and they're typically a part of a, you know, family team. And so we do have that expertise in house. And so if it's relevant, I'll pull someone else in, or someone from our, you know, from our asset allocation team, or from, you know, from our other investment team. You know, it's not just, you know, it's not the Dominic show. There's
Right.
many other players that help us with portfolio management. So I'm happy to leverage that. Just know it's there, and you know, I'm happy to help in any way y'all see fit.
Okay. Well, I think we'll take that under consideration, whether to bring in someone else. I think we have a lot of work to do on our side, though, before we get to that point. I would be remiss if I didn't ask you about Brown's fees, since I think it's been about a year since we've talked about that. Can you speak to
Sure.
how Brown's fees are calculated?
Yep, absolutely. So we are flat fee on assets under management. So the long fund, given kind of the active nature and management of the fund, does have a higher fee. It's 70 basis points. The short term, where we have been managing those over time and rolling, are only 25 basis points. And you know, on any of, I mean, I always think of fees. We're very transparent about fees, and we don't ever want that to ever come in between anything. And so we always, you know, every underlying investment typically has a fee as well. And so, you know, happy to kind of walk through those as well. But our internal fees, we don't, internal strategies, and I may have mentioned this before, but you know, the small cap value, the global leaders, even the bond fund, those particular strategies, we rebate back our management fee. We don't take any additional fees at all. So we give that back to you, the management fee that if you weren't a client of Brown Advisory, you would be paying to buy that fund. And the flexible equity strategy, given it's a separately managed account, there are zero extra fees. There's no fee for our manager to manage that portfolio. And so, you know, the fees are broken out. You see net of fees on the summary, and all of the individual performance numbers, like the individual fund performance numbers, those are all net of fees as well.
Okay. Is there a slide that shows what the fees worked out to?
There is not on here. I'm trying to think the best way to do it. I mean, here you're going to see, right, gross of fees and then net of fees.
Yeah.
Over time, and so you kind of just, we always want to show that net number. We don't, that's what we, I mean, that to me, that's what we're evaluated on.
So it looks like it worked out to about 40 basis points.
Yeah, over time, just because of like buying and selling and things like that, it's been 5 years, and so 6 years. Gosh, it's been a long time. We've been working together a long time. It's a good thing. But yeah, I went back and looked before this meeting, just to kind of double check where we were on fees, and it's is a flat fee of 70 basis points.
Okay. Does anyone else on the committee have questions for Dominic? Okay. Well, we very much appreciate your time. This is helpful. And as I said at the outset, I think you should be applauded for, in a pretty horrible investment environment, performing really well. I mean, the portfolio, I think, has been managed, you know, pretty ably. So thank you for that.
Thank you guys. Thank you for the opportunity to manage this account. You know, we always, this is, you know, a partnership, and we certainly think of it that way. And on a personal note, I mean, I have tons of family in the Delaware Beach areas, and been a full, you know, lifelong resident of Delaware. So you know, it's really means a lot to me to be able to manage these funds, and I take that very personal. So
great.
Thank you guys for the opportunity.
I will be in touch with you. You know, we'll continue to work on the investment policy, or the implementation plan part of it. You know, I know we had traded some work on that back and forth, and I think we're nearing the completion, but I think the committee has to resolve a couple issues before we finalize that.
Okay.
All right. Well, thank you very much, Dominic.
Yeah.
You're free to drop off if you'd like.
All right. Thank you all. Appreciate it. If you all need me, you should have my contact information. So to the extent anyone has questions, feel free to reach out.
Okay.
All right. Thank you, everyone. Have a
Thank you.
great weekend. Bye-bye.
So I guess that leaves us almost where we started, which is, well, item 8 on the agenda is discussion of the investment policy and the implementation plan and possible revisions. I think the fundamental problem that I saw in the investment policy is that the implementation plan is actually mislabeled as the investment policy. It's not really the investment policy, it's the implementation plan of the investment policy. The investment policy is the code, chapter 24, and that was revised last June. And I think that's in pretty good shape. The investment implementation plan, which kind of lays out the specific allocations that we give to Dominic, I think is what still needs to be finalized. And I think a question for the committee is, do we want him to continue to manage 3 accounts, or can we collapse the beach replenishment fund into 1 account instead of having a separate beach short and a separate beach long account? And then I think once we answer that question, we can sort of solve for what are the specific parameters that we want him to invest. Does anybody have an opinion on 1 account versus 2 for the beach replenishment?
I think 1 account makes sense.
Yeah, I'm from 1 account.
I am for as well. I can't remember if there was a reason before. I thought maybe as a result of an audit, but if I'm hearing if that was not the case, then it doesn't make any sense to have multiple accounts in my mind.
Gary, do you know if there is an audit history to that?
I do not know. I'm not aware of anything that would prevent you from going to 1 account rather. The only thought that I had there is that there are some expenditures that come out of the beach fund money, but it's basically cleaning the beach and some other maintenance activities. But I'm assuming that gets handled before it gets to Brown Advisory, I think, in terms of putting the money into the account. But I'll double check the history. I think Bill Stevens made a similar commitment. We'll just check to see what we can find out. But I'm not aware of anything that would prevent you from going to 1 account.
Yeah, I think for administrative efficiency, it would make sense to just be 1 account, and then we can make the allocation reflect that we think some of it is shorter term need. The allocation can just be weighted toward cash to address the short term needs. But I just don't see any real advantage to 2 accounts. In fact, I think it's just the opposite. It might be more advantageous in 1 account. Bernie, did you have anything to add to that?
Well, yeah, last 2 years, at least, nothing in the audits come up. I'm on the audit committee too. So that, I don't remember anything saying we need to have 3 accounts. There's never been a finding that way. But to me, it should be less admin overhead if we only have 2. And we can manage what we need for the short term, because like as Gary said, there's certain things that we take and we purchase from that account, as I understand it.
Yeah. Okay. Well, what I would propose, I mean, I've looked at this before and traded messages back and forth with Dominic on trying to sort of streamline what the implementation plan says. I'm happy to take a crack at trying to get to a final draft that then I can circulate back to the committee and use that as a discussion point for our next meeting, and hopefully finalize it at the next meeting. Does that sound like a good plan?
Yep. I agree.
All right. So I think, as I looked back, I know I had on the agenda that for item 8, discussions of the investment policy itself, chapter 24. I'm not sure that that needs any changes based on what had been implemented back in June or approved back in June. But I will work on revising the implementation plan to clean that up, and we'll circulate it. I think not reflected on the agenda, but as we've discussed throughout the hour and change now, I think, Gary, it does make sense to convene either a joint meeting among the various committees, budget and finance, audit, and investment, or at least a subset of those, so we can try to hash out this predicate question of, what are the short-term needs of the town? What is the long-range planning? What does that look like? You mentioned the government officers study. I think we really need to get that resolved before we can make an intelligent reallocation of the portfolio.
Yeah, I'll work with Bill to see if we can't put together a little background document that describes what it is we need to do, what the task is here, and then move forward with it from there. I mean, it's against a longstanding problem. It's something that's come up in the last 2 audits, and we just haven't gotten it done, and we need to get it done.
Right. Okay. And is that something you think would be addressed at the February council meeting?
That's my plan. I'll talk with Bill some more, and we'll coordinate that with the mayor, and get that on the agenda for February.
Okay, fabulous. So I think then that just takes us up to the next committee meeting dates. This is just a suggestion, but for sake of planning and keeping it on people's schedules, I set out there on the agenda that suggestion that we meet the second Thursday of each quarter, January, April, July, and October. And I would suggest we move it to 5 p.m. rather than 3 p.m., but certainly open to everyone else's views on that as well.
You said April will be the first?
So it'd be the second Thursday of the month, as proposed there, but it's not obviously set in stone. Let me see.
April 8th.
Tax day. No.
No,
No.
tax
The week before.
Week before, yeah, thank you.
So let's see. Pulling up my calendar.
Come on.
So yeah, so the second Thursday in April would be April the 8th. And then in July, that would also be the 8th. And then in October, that would be the 14th. And certainly as those dates approach, we can move them if there are other events that overtake, but at least just to set down a marker that we would meet quarterly.
I like for throwing out the marker, and I'll propose it up to vote, I guess.
Okay.
If we need to do that.
Do we have a second?
Second.
Any nays? All in favor? Aye.
Okay.
All right, then it's unanimous. So those dates will be
Aye.
the 8th, and the 14th for the remainder of the year. Okay, is there any other business that anyone wishes to discuss today? Hearing nothing, then I think